You bought in. Maybe during the run-up. Maybe after hearing about it enough times from enough people that staying out felt like the real risk. Maybe you did your research, read the white papers, understood the thesis, believed in the technology. You weren't being reckless. You were being early. And for a while, it felt like genius. The portfolio doubled, then tripled. You checked the app more than you checked your email. You started having opinions about Layer 2 solutions and proof-of-stake consensus mechanisms. You sent articles to friends who hadn't bought yet. You felt like someone who saw something before the crowd did. Then it fell. Not a little, not a healthy correction. It fell the way crypto falls, fast, confusing, and without a clear bottom. And something happened in that falling that had nothing to do with blockchain technology or market fundamentals or the long-term thesis you believed in. You panicked, or you doubled down at the wrong moment, or you sold at the bottom to stop the psychological bleeding and watched it recover without you, or you held through a drawdown so severe that the original position became a smaller problem than the anxiety it created every morning. The technology didn't fail you. The thesis may still be intact. Your behavior failed you. And that's the conversation that almost never happens in crypto circles. Not the technical analysis, not the cycle predictions, not which coins are undervalued. The conversation about what volatility does to human psychology and why the behavior it triggers destroys more crypto wealth than any bear market ever has. The definition problem. What risk actually is. The word risk gets used constantly in investing conversations, almost always incorrectly. Most people use risk as a synonym for volatility. An asset that moves up and down dramatically is called risky. An asset that moves slowly or not at all is called safe. This definition sounds reasonable. It is functionally wrong in ways that cost people real money. Volatility is the measure of how much an asset's price moves over a given period. It's a statistical description of price behavior, nothing more. Risk, properly defined in investing, is the probability of permanent capital loss, losing money you cannot recover through the normal operation of the investment over time. These are not the same thing. They are not even closely related in many cases. A savings account has near zero volatility. The number goes up slowly and never down. By the volatility equals risk definition, it's among the safest instruments available. But if inflation is running at 8% and your savings account pays 1%, you are losing real purchasing power every single year permanently, silently, without any dramatic price movement. The number in the account rises. The actual value of what that number buys falls. That is real risk dressed in the costume of safety. Bitcoin has enormous volatility. It has fallen 70–80% from peak multiple times. By the volatility equals risk definition, it's among the riskiest assets available. But someone who purchased Bitcoin at almost any point more than 4 years ago and held without selling has not experienced permanent capital loss. The volatility was real. The risk defined as permanent loss was not realized because holding behavior was maintained. The distinction matters because it changes what you should actually be afraid of. You should not be afraid of volatility. Volatility is information. Volatility is opportunity. Volatility is the mechanism through which assets are mispriced in ways that create returns for patient holders. You should be afraid of the behavior that volatility triggers in you. Because that behavior, the selling, the panic, the doubling down at wrong moments, the abandoning of strategy under emotional pressure is where the permanent capital loss actually lives. What volatility does to the human brain. Understanding why behavior fails under volatility requires understanding what volatility actually does neurologically. The human brain was not built for financial markets. It was built for an environment where threats were physical, immediate, and required rapid response. Danger appeared, adrenaline released. You ran or you fought. The response was automatic, fast, and adaptive. Financial markets are the opposite environment. Threats are abstract, delayed, and almost never require immediate action. The optimal response to a dramatic portfolio decline is almost always to do nothing, to wait to hold. But your brain doesn't know that. When your crypto portfolio drops 40% in 72 hours, your brain processes it as a threat, not metaphorically, literally. The amygdala activates. Cortisol floods your system. The same neurological emergency response that would help you escape physical danger gets triggered by numbers on a screen. And in that state, the brain does what it evolved to do. It demands action. Doing nothing feels unbearable. The discomfort of watching the portfolio fall is experienced as a signal that action is required to stop it. Selling feels like doing something. Selling feels like protecting yourself. Selling feels like taking control of a situation that feels threatening and out of control. Even when selling is exactly the wrong action. Even when selling locks in a loss that would have recovered. Even when the thesis that motivated the original purchase hasn't changed at all. The neuroscience is not a character judgment. It's not weakness or irrationality in any personal sense. It's the predictable output of a brain architecture that predates financial markets by about 200,000 years, encountering an environment it was never designed to navigate. Every investor has this brain. The question is whether you've built the systems and understanding to override it when it fires at the wrong moment. The specific behaviors that destroy crypto wealth. Let's name them precisely, because abstract warnings about emotional investing don't help anyone recognize the specific moment their behavior is about to cost them. Panic selling at the bottom. This is the most common and most costly crypto behavior. The price falls, it keeps falling. Every day it falls a little more. The thesis starts to feel uncertain. The people who said it was worthless start to sound right. The discomfort becomes unbearable. You sell. 2 months later, the price has recovered significantly, sometimes fully. You bought the volatility and sold the recovery, the exact opposite of what building wealth requires. The painful irony is that this behavior feels like rational risk management in the moment. It feels like cutting losses before they get worse. It feels like the responsible decision. That feeling is the brain's threat response masquerading as financial judgment. FOMO buying at the top. The equally common, equally costly mirror image. The price has been rising for weeks. Your social environment fills with stories of people who got in earlier. The asset is on the news. Everyone seems to be making money except you. The fear of missing out becomes more psychologically urgent than any concern about valuation or entry price. You buy near the peak, the price corrects. You're immediately underwater. The very social validation that triggered your purchase disappears as the conversation shifts. You're now holding a loss at a price that looked reasonable only because momentum had carried it far above sustainable levels. FOMO is not a personality flaw. It's a social species responding to apparent consensus about where value is moving. But in markets, by the time consensus is visible, the opportunity has usually passed. Overconcentration born from early success. You bought early. The position grew dramatically. Now it represents 60, 70, 80% of your net worth. You haven't made a decision to concentrate this heavily. It happened through success. And because the gains feel like unrealized profit rather than real wealth, because selling feels like admitting the run might be over, you hold the concentration. When the correction comes, a position that represented life-changing wealth on paper returns to something manageable. Not because you made a bad original decision, because you didn't manage the success. Position sizing and rebalancing aren't exciting. They feel like leaving money on the table during bull markets. They are the discipline that converts paper wealth into real wealth. Averaging down without a framework, the price drops. You believe in the thesis, so you buy more. The price drops further. You buy more again. This feels like conviction. It feels like disciplined, value-oriented behavior. But there's a version of this that isn't conviction, it's denial. Buying more of a falling asset because you can't psychologically accept that the original thesis might be wrong. Using additional capital to defend a position rather than to genuinely invest in an opportunity. The distinction matters because one behavior has a framework, a defined level at which you stop averaging down. A clear reassessment of thesis, a position size limit. The other is emotional escalation dressed as strategy. Without a predefined framework, averaging down in crypto can convert a manageable loss into a catastrophic one. The volatility math that breaks people. Crypto doesn't just fall. It falls in a way that makes recovery brutally hard, down 50%. You need 100% just to break even, down 75%. You need 300%, down 90%. You need 900%. That's the trap most people don't understand until they live through it. The drop and the recovery are not equal. Losses hit harder than gains recover. That's why volatility destroys people psychologically. Not because the asset moves, but because the recovery takes longer, hurts more, and tests patience beyond what most expected. The investors who survive multiple cycles understand one thing: position size matters more than conviction. If a 70% crash would force you to panic, lose sleep, or sell at the bottom, the position was too big. The right size is the one you can survive emotionally, financially, and mentally, even in the worst market conditions. The information environment that makes everything worse. Crypto never sleeps, traditional markets close. There are pauses, time for emotions to cool down. Crypto runs 24 hours a day, 7 days a week, all year long. The price is always moving. The app is always open. The notifications never stop. And that constant exposure changes behavior. The more people check the price, the more emotional they become. Not calmer, not smarter, more reactive. Fear gets stronger. FOMO gets louder. Anxiety keeps feeding itself. Then social media amplifies everything. In bull markets, everyone sounds certain prices will go higher. In bear markets, everyone sounds certain it's over. Crypto, Twitter, Reddit, Telegram, Discord, these environments reward emotion, confidence, and extreme opinions. And slowly, people stop thinking independently. They follow the crowd emotionally without realizing it. The information environment doesn't just reflect crypto volatility, it magnifies it. What actually works? Behavioral architecture, before the volatility arrives. The way to survive crypto volatility is not by trying to become emotionless in the middle of a crash. When fear takes over, the brain stops thinking clearly. Discipline built in the moment usually fails. The real solution is building a system before the chaos begins, when the market is calm and your mind is clear. Before buying anything, define your thesis clearly. Not just crypto will go up, but a real reason for why the investment should work. What needs to happen for the thesis to succeed? What evidence would prove you wrong? What timeline are you actually investing on? A clear thesis gives you something stable to rely on when prices move violently, instead of making emotional decisions based only on fear or excitement. Position sizing matters just as much. Crypto can fall 70 or even 80% from its peak, and that is not unusual. If a drawdown that large would damage your financial stability or push you into panic, then the position is too big. The goal is not maximizing returns. The goal is surviving long enough to stay rational. The strongest investors also create rules before volatility arrives. Rules for when to buy more, when to hold, and when to exit. Not based on emotion or daily price swings, but based on changes in the original thesis, time horizon, and portfolio limits. Decisions made calmly are usually far better than decisions made during panic. And finally, control the information you consume. Constantly checking prices increases anxiety instead of reducing it. Social media feeds emotional reactions more than thoughtful analysis. The more noise you consume, the harder it becomes to think independently. Long-term survival in crypto is not just about managing money. It's about managing behavior. Closing. Crypto may change the future, but that means nothing if volatility breaks your behavior before the future arrives. Most people don't lose because the thesis failed. They lose because fear took control. Panic at the bottom. FOMO at the top. Positions too big to survive emotionally. The investors who last through multiple cycles are not the smartest. They're the most prepared. Because when the market crashes and emotions take over, you won't follow logic. You'll follow the system you built before the panic began. And in crypto, that difference changes everything.